There's something happening in global markets right now that most people haven't noticed. And honestly, I don't think the financial media has noticed it either, because they're so focused on rate cuts, inflation prints, and whatever Powell might say next. But here's the truth. Liquidity doesn't wait for speeches. Liquidity doesn't move when someone finally admits there's a problem. Liquidity shifts quietly, beneath the surface, long before policymakers acknowledge it. And over the past few weeks, I think we've started to see the earliest signs of a liquidity bottom forming. Not a full pivot, not a stimulus, not a market rescue, just the first subtle signs that the pressure might be easing. Now, if you've been watching my recent videos, especially the ones about reverse carry trade, the pressure building in Japan, and the potential for a rate increase by the Bank of Japan, then this will make even more sense, because all of these stories feed directly into what's happening now. Hi, I'm Paula. Welcome back to this channel. Here on this channel, we break down macro, crypto, and global events in a way that cuts through the headlines and actually makes sense, so you can understand what's really driving this market. So let's take it step by step. From here in the UK, it's easy to feel like the big macro stories only happen in the United States or Asia. But when liquidity shifts, it doesn't matter where you are. It affects the FTSE, the S&P, crypto, real estate, banks, everything. And right now, some very important signals in the global liquidity system are starting to change. One of the biggest ones is the reverse repo facility in the United States. For nearly 2 years, reverse repos have been draining liquidity out of the system. They've been a massive suction pump pulling cash out of markets and into the Fed. And that drain has now almost completely stopped. Reverse repos are basically empty, and historically, when the RRP flattens out at the bottom, liquidity pressure stops getting worse. It doesn't mean the system is suddenly flush with money, but it does mean the bleeding slows. At the exact same time, the Federal Reserve has announced that it's ending its balance sheet reduction, the QT process, in December. That means the Fed will no longer be shrinking liquidity at the pace we've seen for the last couple of years. This is a huge signal. QT almost always ends before official policy pivots, and markets usually react long before the Fed tells them to. And there's more. Banks in the US have been tapping the Fed's repo facilities at record levels. That tells us short-term funding pressures exist, but it also tells us liquidity is being supplied into the system. When institutions need cash, the Fed has chosen to provide it. That's a shift from the last 2 years, where the bias was removal, not support. Then there's the Treasury. They've quietly been changing the way they borrow. Instead of issuing lots of long-term bonds, they've been leaning more heavily into short-term Treasury bills. And why does that matter? Because bills are easier for the market to absorb. They drain less liquidity. It's a softer, more cautious approach. And in previous cycles, this kind of issuance shift has happened just before liquidity conditions improve. But this is where everything gets even more interesting, because these changes are happening at the same time as global tensions are rising. Not just geopolitical tensions, but economic ones. You might have seen Trump's recent comments about reshaping the automobile industry in the US. He spoke about bringing manufacturing home, placing tariffs on imported cars and parts, and rebuilding domestic production. Now, whether you agree with this policy or not isn't the point. The point is that industrial policy shocks, especially in huge sectors like automotive manufacturing, they create big financial ripples. And we've seen this before. In 2018, the trade war between the US and China triggered a slowdown in global manufacturing. Markets fell almost 20%, and the Fed, which had spent all year telling everyone that rate hikes would continue, suddenly reversed course in early 2019. Industrial stress became liquidity stress, and liquidity stress forced a policy response. We saw the same pattern in Europe in 2012. The Eurozone crisis crushed the auto sector. Banks were stuffed with industrial loans, and the European Central Bank had to unleash over $1 trillion in LTRO lending to stabilise the system. Industrial stress became financial stress, and financial stress demanded liquidity. And of course, in 2020, the global shutdown wrecked supply chains. It froze auto production and caused a global credit crisis. The Federal Reserve responded with the biggest liquidity flood in modern history. Repo operations, swap lines, corporate bond purchases, QE, everything. A manufacturing shock didn't stay a manufacturing shock. It turned into a liquidity shock. So when Trump stands up and talks about reshaping the auto industry, the financial system listens. Not because of the politics, but because industrial disruption can create uncertainty, and uncertainty affects liquidity long before it affects GDP numbers or market headlines. Now add Japan into this picture. If you've watched my video on reverse carry trades, you'll know that Japan plays a massive role in global liquidity. Traders borrow yen at ultra low rates, invest abroad, and then pocket the difference. But if Japan raises rates even slightly, that entire structure can wobble. Carry trades unwind, traders sell assets globally to buy back yen. Liquidity dries up, FX volatility explodes. This is why Japan's potential increase is such a big deal. And it's why all of these liquidity changes in the US, the RRP draining, QT ending, rising repo usage, Treasury bill issuance, might not be coincidences. They might be preemptive adjustments to global liquidity pressure. Central banks often see the storm before the rest of us. And when different parts of the global system start flashing early warning signs, Japan's yen pressures, industrial tensions in the US, European manufacturing softness, UK property issues, policymakers quietly start adjusting the plumbing. They don't announce it, they don't tell the market, they just shift the pipes before anything breaks. And that's what I think we're seeing now. The liquidity system looks like it's in the early stages of rebalancing, not easing, not stimulus, just shifting. And crypto, as always, is the first asset class that reacts. Because crypto is global. It's 24/7. It senses changes in risk appetite before equities, before bonds, and definitely before policymakers admit the truth. Right, before I go on, I know a lot of you ask which exchange I actually use when I'm trading through these kind of macro shifts. One of the platforms I often use is Bitchinix. Mainly because it's straightforward, reliable, and doesn't overcomplicate things when you're trying to execute quickly. I reached out to them since the questions keep coming in, and they've given my subscribers a special link with bonuses for signing up. It's in the description if you want to check it out, completely optional, but there if you want the extra perks. Right, back to the bigger picture. So the real question is this. Are these subtle liquidity signals hinting at a bottom in global liquidity conditions? Are we in the very early stages of the next cycle? We won't know much for sure until much later, but that's how liquidity turning points work. They feel quiet, insignificant, almost invisible, until suddenly everything moves at once. For now, I'm watching the plumbing. The reverse repos, the repo usage, the Treasury issuance, Japan's yen dynamics, industrial policy shocks, Asian liquidity injections, and how crypto reacts to all of it. Because none of these signals matter on their own, but together they tell a story. A story that says the tightening pressure might be ending and markets won't wait for Powell to confirm it. Let me know what you think. Are these early signs of a new phase? Or am I reading too much into it? And of course, if you want to understand how we actually navigate these kind of macro shifts, we've created a completely free trading course, not just for the Crypto Wolfpack community, but for everyone. The link is in the description below. Thank you so much for watching, and I'll see you in the next one.